Our models are trained on about 100 years of data across 50 different markets. So deflationary episodes are rare, but if you have this much data, they have appeared. It takes a while to actually see the shift. And by the time it becomes obvious and is on the front page of the Wall Street Journal, it's too late. That's when you want to exit.
One theme or thread that I'm seeing as we're talking here is this democratization of the technology itself, with generative AI now being so accessible to the retail investor. One could arguably tune some of that with the addition of some open source software to build an agent or build an AI analyst that could replicate some of what you're mentioning and a lot of what we're trying to do, perhaps maybe different sequence, different model. So from a founder's perspective, how do you feel about that? Because on one hand, it's helped you close that gap in the last 6 years that you guys have been running. But at the same time, it's also increasing competition because there's a lot of smart kids perhaps even coming out of Chicago who said, look, we understand the principles and the approach to fundamental analysis combining with a macro overlay, plus a tactical trading algorithm. And these three agents could possibly be designed to work together with a little bit of training through both generative and LLM and deep learning models to build kind of like a rough architecture of what we're doing, in a way building a team in the way that you have. How do you feel about that in terms of staying ahead? Is this an arms race? Is this an arms race at all? Or is there something in the bottleneck in the whole ecosystem that still allows professionals and active managers like ourselves to stay ahead of newer teams that are coming through the pipeline?
No, it's definitely a race. And markets, we have now market data going back 400 years on the Amsterdam Stock Exchange, London Stock Exchange, and people have been looking for ways to get an edge. It used to be, you send a kid to run to the pier to see whether the ships coming in are low or high and take and see if they're loaded or coming back empty. And then the kid runs and gives the information to the person who paid him. And this person starts trading. The person next to him doesn't know exactly, but can figure out which way the wind is blowing. And so they jump on that and so on. So people have been looking for ways to get an edge. So that's part of the nature of the system. And it's not going to go away. But at the same time, because there's so many smart people, it is very, very hard to maintain an edge. And we think of the market as a complex adaptive system. That's why language model has a hard time navigating it. Language is much more stable than the market. So what we have built in-house is a domain-specific, it's a large investment model that has a similar architecture in some respects, but is also quite different. It's purpose-built for the stock market. Yeah, and so we continue to develop it. People tend to ask us, how do we find new signals and how often and so on. We're always finding things and everyone is looking for the Holy Grail, but the big things, again, for the last 400 years have been value and momentum. And so what's happening is you get more data, you become more sophisticated in formalizing the strategy, in expressing it and refining it. But it's very hard to find another thing like that because that's just the way people react to information and behave in crowds. So we accept that other people will be using similar tools and competing. And that's why it's exciting. If we didn't like that challenge, we wouldn't be doing it.
Does it instruct how you build a corporate culture? You mentioned earlier about building a quant team from the ground up rather than as an add-on, which is what a lot of traditional finance firms have done. Guys like Invesco, for example, they've built like a passive AI quant strategy, but it's really part of a larger menu. When you're building your team and knowing that you have this every generation, you have new competition coming through the pipeline, and then this technology made more accessible. How does this instruct you when you're building your team internally, both from an IP protection perspective, and then secondly, also from an efficiency perspective? So let me give you a basis of where I'm coming from, right? So I have a team that I just met last week. They had just left a large US firm, and they're rebuilding a team out in mainland China. Cost on average is much lower there, plus they have a really high talent pool. So for them, the advantage is having more access to stronger talent pool that allows them to research and develop new signals and new ideas. And then I met another team in Taiwan just a few years back, and his philosophy was building AI research agents. And so from research agents, they would become AI portfolio managers. And so starting from more base tasks of research, he would then create a almost like a stagger or a staged up model where he would have algorithms managing algorithms with a central nerve center. And that's his model. And his idea was to keep the team really lean because there's sufficient technology that could run through and process fundamental research as well as code optimization. So, and these are two very, very different philosophies of building your organization. So the Taiwanese manager only needs to run a team of like 4 or 5. Whereas the China manager that I met recently, he's running a team of 30. So what's your philosophy in terms where you'd like to be and how you want to build the firm?
Yeah, so I think that's why it's an adaptive system. People are coming from different angles and they'll try different things that play to their strengths. I know that when I was at Morgan Stanley, the way we'll build a team, we'll come up with a headcount, org chart, the types of resources, and then we'll go out and hire them. And when I compare this to the team that we have, which was without any budget, everyone came here to build something because they believed that they have something to say about the way you should manage a fund. And the only thing we care about is high quality returns. And the people who would leave a big shop to go and do it are very different from those that would go from one big shop to another big shop because they get a bigger package. These people have very good CVs, but they tend to be risk averse and they like to operate within a structure, climb the ladder, and so on. And so we have a bunch of people who, they came out of the big places, they're good for training. But as you can see, Google was the clear leader in AI, and suddenly they got eclipsed by this little startup out of nowhere. And so when you think about arms race, you might think, okay, how many PhDs do you have? Google obviously has way more PhDs than OpenAI, but it's not about the number of PhDs. It's the people you get, the personalities, and the room you give them to be creative and to try different things. Again, if you're inside a big organization, they will fund you, but they're going to be watching over you. And so they're going to box you in. And when you're boxed in, you can iterate, but you cannot really create new things. And so if you look at the backgrounds, the CVs of the people that we have, they would look like a very expensive team that a big shop could hire with a large budget. But that doesn't capture the nature of the people because they walked away from these places in order to not be a cog in the machine, but to build something of their own. And that, I think, is the key if you want to bet on innovation.
I think this is a really good segue to talk about what you mentioned earlier, spot on about the quality of research that comes out is really more important than anything else, regardless of what model you pick. In our last discussion, we had a chat about how your signals were able to alert the team as well as the whole book on paradigm shifts in the market. And I really like the case that we talked about then, which was specifically about China in 2022, 2023 shift, where most of the traditional long-short equity managers onshore and offshore really got China wrong and got pretty fleeced probably across 3 events over the last 2 years. And even the quant managers onshore who were boasting onshore alpha, they got routed pretty hard in January. But your system was able to sidestep most of that. And why don't you walk through what happened and how your system was able to show that paradigm shift in China, and you were able to really beat the market quite significantly, in fact. And I don't want it to spoil anything, but maybe you can tell us a little bit about that story.
Yeah, so again, it's about the people. We don't have any statisticians on board. We don't have any physicists. We don't even have any computer engineers, even though it's very much a technology-focused firm. We have economists who can code. And so it's very much an economically driven investment first approach. So every signal we deploy is going to have an economic story underpinning it that we have to understand and be comfortable. So we don't do any data mining that finds amazing signals, amazing strategies, incredible Sharpe ratios within a particular data set and then deploys them without actually understanding what it is you're doing. And that we feel is very robust, number one. Second, as part of that philosophy, we don't do any portfolio optimization. We don't do any long-term forecasting top down. We do not optimize the signals. We use a dynamic scoring approach, which is much more robust and more simple. And so what we had is a very large funnel that ingests a lot of data, and then the technology is there to help you see it and distill it. And so you can think of it as a groundswell of information coming from every business in the world, and then you can pull back from that and you have a very crisp view of the world as it is today. And if you get that and you can distill it, it's pretty clear which businesses you want to invest in, which ones you want to bet against, and which ones you want to avoid. And then tomorrow, as the world changes, you update your view and you adjust the portfolio accordingly the day after tomorrow and the day after tomorrow. So that means that in the case of China, you don't have to speculate about the third plenum or Taiwan or Trump winning the election and bringing back the trade war. Any of these things we don't speculate on, because even if you know what's going to happen, the ramifications on the market can be very counterintuitive. So that approach is particularly powerful when you have a regime shift after a long regime. Generals tend to fight the last war. And so after 9/11, everyone was focused on terrorism. And after the trade war, it was focused on the relationship between the US and China and global trade regimes. When COVID hit, the world changed very quickly. And then first, China was very much impacted. Then China seemed to get by much better than anyone else. And then it turned out it wasn't like this. And then there was a lot of regulations and the real estate market. And so all these things from 2015, 16, after the last big sell-off, you've had this China growth story being driven by the platform technology companies with a lot of foreign participation. They were just looking for the Chinese Amazon and Chinese Google. And these things worked very well for a while. And when the world changed and China went from growth to deflation, they sold off, and suddenly Tencent was trading much lower than where it had been trading before. So the instinct was, oh, I'm just going to buy this dip. But then it drops another 30%. And many people then sort of ran out of ideas. And especially foreign investors just said, why bother? I can invest in India. China is uninvestable to me. And it doesn't make sense. I'm going to wait it out. So actually last year, there were a number of companies in China that went up, and you just had to find them. And they were not the old winners. They were new winners. And our models are trained on about 100 years of data across 50 different markets. So deflationary episodes are rare. But if you have this much data, they have appeared. And so the models just shifted into these companies that were going to be the winners, the high dividend paying, strong balance sheet, SOEs, and other very defensive companies. And that happened bit by bit by bit. We didn't know it. It takes a while to actually see the shift. And by the time it becomes obvious and is on the front page of the Wall Street Journal, it's too late. That's when you want to exit. And so when I looked at the end of last year, our China performance compared to the index, we had found the winners. We had avoided betting on the old winners. And most importantly, we had escaped some of the big losers, which were some of the large developers, which were very large exposures in the index. And the index held them until the bitter end. So they were down 95%. Our largest losers were down 40%. And, avoiding these big crashes is less glamorous than finding the amazing winners. But actually, in terms of alpha generation and on a relative performance basis, it tends to be the low hanging fruit, because sometimes finding businesses that are not well managed or have regulatory overhang is much easier than looking for the next security that's going to double or triple.
So that's fascinating, because I just want to reflect on this a little bit, because